reading from the article that is coming. That's what at least one financial expert is saying. Charles Brown of CB3 Financial says,
one of the brilliant moves that Kmart has done is to partnership with Facebook in these e-gift certificates, so you can actually...
Of government mismanagement. Charles Brown is the president of CB3 Financial Group. He joins us this morning from Chicago.
Significantly dropping. Basically, this is the year of the consumer.
Believe that they're capable of managing anything?
Well, it's sort of like handing the keys to the chicken coop to two wolves.
Good evening, everyone. From Chicago, it's Thursday, June 18th, and I'm your host, Charles Brown, Portfolio Manager with CB3 Financial Group. We're so glad you've joined us tonight. We think it's going to be a great program, and we're really glad you're here. From COVID to clarity, this is CB3 Live. Our tonight's top 3 coronavirus cases are now inconsistently rising in some states. Okay, that's not good. Retail sales are shockingly good for investors and bad for the gloomers. You remember last week I talked to you about gloomers and doomers? Well, it's bad news for them, but great news for us. And the bull case, bear case discusses real CB3 investments and some surprises. All right, let's go forward. Okay. So we got to cover this data every time, and that's because the cases are rising. It's not everywhere, but as I said in the opener, 26,000 almost new cases since yesterday. This data is just as of this morning. Well over 2 million cases, 117,000 plus deaths. I don't want to say it's a wave 2 because I'm not sure we ever really finished wave 1, but definitely cases are on the rise. And the good news is, though, that Moderna, as you know from watching this program now, this is the 15th episode, I'm going to bring you primarily good news because you can get the doom and gloom elsewhere. Moderna is a company we've been talking about for quite some time. We don't own them because they're a very mercuric stock. But Moderna is now in its final study next month with 30,000 people, not 1,000, 1,500, 2,500 like these small earlier stage tests, 30,000. And that's a huge positive, and the market sees that, and I think that's why it stays strong. If you can't see the numbers on this, it's okay. I want you to just look at the line. Notice that it's turning up the last 4 to 5 weeks. That means the moving average of the number of cases is increasing, and that's not what we want to see. Now, it's not everywhere, as I've said, and actually the places that it's rising are kind of surprising. So the dark spots, again, you can't see the text because it's just too small a map, but the dark areas are where we're seeing an increase. And the interesting thing is that it's in the south where it's the hottest. The expectation was that maybe cooler areas of the country, the virus would linger longer, but that's not what we're seeing. Interestingly enough, Georgia was the first state to reopen, and only spotted areas of Georgia have seen a resurgence. So far, Georgia's still in the lead as far as reopening. What's happened, though, is because of this, again, if you can't see all the type, the blue bars are deferred or delayed payments for May. The gray bars are April. So you were seeing an increase in people that are needing to defer payments. Now, it's hard to tell from the data that I have in the last few days whether this is across the country or if it's just specific to the areas that I've been mentioning. But I'm guessing it's specific to those areas, and I'll have more data for you next week. But we expect that that's why it's been tougher for those areas to fully open back up and to reclaim those jobs. Now, I wanted to put this up here because I'm eating a little bit of crow for you guys. All right. I was making fun of the people that were making fun of Sweden for not locking down more vigorously. And I actually want you to look at this chart in reverse order. So look at the U.S. first on the right, and then we're going to go left. See, it's a steady move down until this last little pop right there. And that's what we're talking about tonight, that pop. Italy has not gotten that pop. They have been straight down. But look at the far left. Look at Sweden. Look at those new cases. That is a startling number and pretty conclusive evidence to me that their laissez-faire approach over the last 3 months has not worked very well. Now, you could still argue their population is much smaller, but percentage-wise, that is not a good graph. I showed you this chart last week. It's updated a little bit, but mainly what I want to highlight is the increasing acceptance. And the increasing acceptance means when the dots are farther apart, okay? So going out to eat, maybe 35% of the population is now okay with that. And I want you to know that I'm in that group. My wife and I ate outside. They closed down Main Street here in our suburb of Chicago, and they put canopies out, and hundreds of people are eating outside, spaced 6 feet apart. And we're trying to get back to a little bit of normalcy. But as you go down the list from vacation to shopping mall, gym, concerts, and traveling abroad, notice there's not much traction. So it's a slow process, but it is getting better. You're hearing a lot of talk now about the second wave, and you, like me, might be saying, well, gee, are we really through with the first wave? We're not. But the gloom and doomers want to already talk about what's going to happen in the second wave, or if there's going to be a second wave. If you were watching very early, I did what I called the good, the bad, and the ugly. And it looks similar to this. So if things go well, if mitigating factors are not an issue, I'm expecting to see the S&P about 3150 or up 20%. If there's a global recession to the right of that, the S&P won't do as well. And then the baseline or the bad case and then the ugly case, you may want to play this video back and stare at these a little bit more. But these are essentially my forecasts for what's going to happen in any of these scenarios. I stick by the top line. I am still very much in the V-shape stock market correction because it's already happened, certainly in the NASDAQ, not the other markets, but it has in the NASDAQ. And I still believe we're going to have nearly a V-shaped recovery in the economy, which is different than the market. We've talked about that extensively. Okay, so let's go forward here. This is going to be too tiny to see, but this is some material that I've learned since last week with you guys. And maybe you've seen this, and if you have, then just stick with us. But it's important, I think, that we realize there's more data coming out now on how this virus transmits. Coughing, talking, breathing, these droplets leave our body and they go out into the air. If enough of those collect and another person is nearby for long enough, now this is something I didn't know, but the difference between being exposed 2 to 3 minutes is different than 6 minutes, is different than 10 to 12 minutes. Meaning if you walk by a crowd of people, the chances of if one of them has an infection, you're probably not going to get it. But if you stay in that crowd, in that closed area, indoors, you have more risk. You can see in step 3 here, what happens is the virus makes its way into your respiratory tract where it then replicates. And that is when you become infected with COVID-19. That's how this works. So it takes a whole lot of the mystery out of how many different ways can we get COVID. First of all, do we need to be 6 feet or 10 feet? Well, the data that I saw said 6 feet for sure, 10 feet's really good. Is riding in an elevator risky? We have an elevator in our building. I won't ride in it if anybody else is in there. And if somebody steps in, I step out. And that's the information that I'm seeing. And if you have to ride in an elevator with someone else, turn around and face the wall, and you can tell them I don't, want to offend you, but that's what I have to do to be safe. Okay. There's just a growing consensus that this surface contamination and fleeting encounters, meaning passing by someone, are just not going to get you infected. My wife and I used to disinfect every package that came in the home, the groceries, everything. We still open things in the hall, but we're not wiping everything down because the information is conclusive enough now that that's just not a huge risk. Okay, so it's not common to contract COVID-19 from a contaminated surface, a countertop, a paper bag, something, a mail that comes in your home. And encounters outside are unlikely to spread it. I found this encouraging because now I'm going outside, staying 6 to 10 feet away, and feeling completely safe, like everything is just okay. I realize there's still some prohibitions on my behaviors and my proclivities, as it were, and activities, but I still am better off now knowing that 6 to 10 feet is really all I need to do. So the major culprit is these interactions for extended periods of time. Crowded events, poorly ventilated areas, talking loudly, or singing. One of the cases that I read this week, being a musician, I had a big interest in this, was some choir practice where they just decided to ignore the rules in April. 56 people showed up, they were all singing together, and 43 of them were infected. So, no choirs indoors where everybody's close and spit's flying out of their mouth. I mean, we're just not at a point where we can do that. These findings that I and others have read, and maybe you've seen these, but if you hadn't, I really wanted you to see them, okay? They're helping businesses and governments develop reopening strategies to protect the public health, including plexiglass barriers. We saw that in Costco. Good ventilation systems, keeping the air conditioning running, keeping the fan running, and keeping windows open when possible. Why is this important for a financial program? Because the companies that do this and protect their employees keep their product lines going. Obviously, there's a human factor here, and I'm certainly not disregarding that. But as a financial program, we want people that are running businesses, that are taking things seriously, protecting their employees, protecting their clients coming through the doors, protecting their shipping agents. And those that can do that and keep their engine of economy running, those are going to be the ones that are most successful. Now, I found something kind of unusual, and I want to share you with this. Those of you that have been watching me for years know that every once in a while I find something kind of oddball. So this is an airline. It's a brand new airline, and it's called COVID-Free Airline. So this is a picture of one of their actual jets. Now, this is probably the craziest thing I have ever seen to try to be socially distant. Actually, that's probably a stretch, but it's close, all right? So we're looking for companies like this that can be innovative in their ideas so that their customers and clients and employees can feel safe. And that's what we want to do as we get back to some normalcy, okay? So this may be the most controversial slide in the whole presentation tonight. Here's the good news. We're in a recession. We're in a recession. Why is that good news? Because we no longer have to worry about entering a recession. My previous wife and I, when we were early in our marriage, we had fears that we might get pregnant sooner than we wanted to. And the thing is that when she did get pregnant, we didn't have to worry about that anymore. Now, if my daughter is watching, Meredith, we absolutely wanted you. You were not an accident. But there is some sort of relief knowing that, okay, we're in a recession. Great. That means a recession can't happen. Here's the last line that's so important. We know how every recession ends. And how it ends is economic growth. Okay? So, this is a show about being positive. The good news, we are in a recession. It's okay. We can live with it. We're going to get out of it. Okay? Let's take some questions here. I'm going to look through the chat. And so, did this week's COVID second wave, whether it was news that you saw here from me or other places in the media, has it made you feel anxious? Type an A if, well, no, it didn't make me feel anxious because a small case rise is to be expected. B, yeah, it's going to be a major second wave. C, I don't know. Or D, I'm not really sure what to think. And I'm going to look for any comments, questions here. Type an answer and we'll discuss it a little bit, guys. Hey, Andre. Hey, Nellie. All right, we got some answers here, guys. A for Charles Todd. Thank you, Charles. Thomas in Lake Geneva. We got A. We got a bunch of A's. Melly's an A. Okay. All right. I ran this by last week. I wanted to see if I ran it 2 weeks in a row, if I'd get different answers. We got all A's. We got straight A's, just like what my mom wanted for me in college. Oh, Andre, we got a B. Okay. All right. Maybe. There may be. Got another A. Error. Okay. Going to retype, Thomas? Guys, thanks for the answers. Let's move on and let's see what else we got here. Looking at the economy. By the way, I'm going to try to get you out of here a little bit earlier tonight. I know the shows have been running long. The goal was to make these like 35 to 40 minutes, and I'm going to try to stick to that this week if I can. So let's look at the economy. So the NASDAQ, guys, this is just crazy. I mean, the NASDAQ is up almost 11%. Almost 11% for the year. S&P negative, Dow negative, Russell still very negative. But those of you that have been watching from episode 1 know that these numbers were horrible back then, down 38% for the Russell. But the NASDAQ back in positive territory. So that bodes the question, why are there investors sitting on the biggest pile of cash ever? And this is from Reuters. I mean, these guys know their data. Head-spinning economic uncertainty. I get that. But the market is talking. Thanks, Martha. Got your A there. Jimmy got a B. Okay, we got some B's and we got some A's. All right. So we're sitting on this huge stockpile of cash. Where's this coming from? Nobody on this phone, on this call is, if you're listening to what I'm saying and if you're one of my clients, you're not in cash. But there are people that are. Nearly a third of investors above the age of 65, that would be my age, dumped all their stocks, not some of them, didn't lighten to 80%, 20% cash, dumped all their stocks between February and May. Look at this data. Now, all investors, it drops because there are some younger that didn't do that. So my question is, this is an asset allocation problem that, whether you're talking to me or somebody, you need to address. You just can't go to 100% cash and then miss. If you guys remember the data from last week, the S&P, well, the NASDAQ has had, like a 53% move off March 23rd. You can't miss that. You just can't. You can't miss all of it. I understand some caution, but it makes no sense to me at all. So if you look at this data for Bank of America, and I'm sorry it's a little blurry, but it's the best chart I could find on this. Last month in May, people were 75% were saying it's a U shape or W shape. So that's like as opposed to a V, which is just and away you go, like a swoosh from Nike, right? All right. So they've gotten a little less bearish on that, but many investors, 53%, are saying it's just a bear market rally. In other words, we're going back down again, if not to March 23rd, which would be quite a move right now, way back there. More people are in the bull market camp as of June of this year. And then as far as the number of people saying it'll be a V-shaped recovery, well, that's risen from 10% to 18%. I am pretty much in that camp. I don't know the exact shape of it. I know that the market has already set the tone with a very much V-shaped recovery in the tech sector. The NASDAQ 100, they are both at lifetime highs or near it. They certainly have taken out the highs from February. So what does this mean? What does this mean going forward? Let's look at good data. This has just happened since we've seen each other last week. May's leading economic indicators. This is a package of various things in the economy. Up 2.8% versus briefing. This is the survey company that I use, versus 2.5. So it's 0.3% better. The prior number for May was minus 6.1. I mean, that's an enormous jump, almost a 9% jump, guys. And this is the number we're really going to hone in on in this report. U.S. retail sales. You see that green bar that's to the left, the one that's straight down that hits the bottom of the chart there? Now look at the one next to it. That's an astonishing turnaround. This was such a big number that the guys on Bloomberg, who I affectionately call Gloomberg, had to reread the number 25 seconds later. I sat there at 7:30. This number comes out at 7:30 Central Time. And they just couldn't read it. It's like, we got to double check this. The same thing they did for the monthly non-farm payroll for May, okay? Because nobody's ever seen this kind of turnaround, all right? But the market's been telling you this. Guys, this just didn't come out of nowhere. If you want to see how things really are interpreted, you look at the people that are placing bets. Do you want to listen to and make a hunch on, for instance, who's going to win the presidential election for a bunch of people sitting around at a cocktail party? Or do you want to look at the Vegas odds? Now, I'm not suggesting that you go to Las Vegas and bet on the presidential thing. I'm just saying that when people put money to work, whether it should be done in gambling, I don't know, but if it's in the market, they have a strong opinion, they've researched it, and they have what we call skin in the game. All right, off my pulpit here. Look at this bounce. I went back an extra year here. This reopening bounce, this big black line, we haven't seen data like this since 1992. And so for tonight's little quiz here, type one or two words. Tell me what caused this huge bounce in 1992. 1992. Let's see who's paying attention here. What happened in the economy? What did we pull out of? Anybody? I'll watch for it, okay? And then I'll move forward. All right. Weekly spending, apparel, department stores, air travel, transportation, what's flat? Movie theaters. And I'm bummed about that. We have a little theater down the road here. Alice and I walk down there pretty frequently, at least every 2 weeks, and see something, great price. And there's never anybody in there. I don't know why they can't reopen, because it'd be very easy to physical distance or social distance in that theater. But theaters aren't getting any love, but the rest of the areas certainly are, okay? And it's okay, Tommy, if you were 13 in 1992. So if you guys give up, all right, I'm going to respond right here. Here it is, the one word that you needed. Kuwait. Kuwait is the answer. We ended that brief recession with Saddam Hussein and the invasion of Kuwait. That's when the last time retail sales had that crazy a number, okay? Now, I realize the numbers that I'm telling you, as I've done every week, these are not net positive numbers. These are relative positive numbers. So even though you may not be able to see all the numbers on this graph, the blue bar is April and the May bar, the May is red. All right, so what does that mean? Well, if it's a negative number, you want a shorter bar. All right, and you're seeing that all the way through those categories: clothing, furniture, electronics, sporting, miscellaneous, everything, motor vehicles. And on the right-hand side, you want to see the red bars go farther because those are positive numbers. Building materials, food and beverage, non-store retailers. That means online. Okay, huge gain, 25%. Okay, no surprise there. So retail sales for the month of May surged 17.7%. We've been looking at this data. What's the key takeaway? There was pent-up demand. It didn't just fabricate out of nowhere. These are people that have been waiting. They've been watching this show and hearing the good data, and they said, heck, we're going to be all right. I'm going to go out and spend. And that pent-up demand is the data that we're seeing this week, last week, the last few weeks actually, and I think it's going to continue. Motor vehicles and parts up 44% after declining 12.3 in April. I know it's a lot of data, guys, but you just got to see this. This is America coming back. Furniture and home furnishings spiked 90% after declining 48%. Just unheard of numbers. We didn't even see these numbers in the Great Depression. Food services and drinking places, 29% after 34% dip in April. Gasoline sales, now this isn't too dramatic because there's still not a whole lot of people driving. But they rose almost 13% after declining 24.5%. Clothing accessories, okay, surged 188% after declining 75%. That is an insane turnaround. Billions of dollars here. Non-store retailers increased 9% on top of a 9.5% in April. All this says, people, is that the data that I've been telling you continues to pour in. So I'm hoping that you're going to get optimistic by that if you're still not optimistic. What I want to show you now is a little summary of everything I've talked about for retail sales, because it's really important that you understand that the discretionary part of GDP in America, we had a video on GDP 2 weeks ago. Okay, the consumer spending component of that is really important. Let's see if this helps.
Retail sales, a measure of purchases at stores, restaurants, and online, increased in May by 17.7% from a month earlier, a positive sign as the economy looks to bounce back from coronavirus lockdowns. This type of spending is a big deal. Although it makes up a relatively small portion of GDP, it's an important driver of economic growth because retail sales affect more than just retailers. They create a ripple effect throughout the economy. That's why analysts and economists are paying close attention to this monthly indicator as a way to gauge whether the economy at large is recovering. Here's how the retail spending ripple effect works. When consumers spend at stores, those stores order more merchandise, which means manufacturers produce more and order more raw materials. So when consumers open their wallets, the economy tends to run smoother. And this type of spending adds up. Retail sales have been growing for decades, except for a short dip around the last recession. Between 1992 and 2018, retail sales have almost tripled from $1.8 trillion to $5.3 trillion. This includes auto sales, sales at clothing retailers, and general merchandisers like department stores, food and beverage sales, and e-commerce. During the pandemic, some of these categories have struggled more than others. Auto sales declined sharply as lockdowns swept across the country in March and April.
The biggest component of retail sales is spending on new cars and also spending on gasoline. Now, those two categories have been really hard hit in the coronavirus pandemic because people are not commuting, so they're not spending on gas. And also because there's been so much fluctuation in the labor market, people are sort of less inclined to buy a new car because they might not necessarily be sure if they're going to have a job next month.
Many brick-and-mortar clothing retailers and department stores saw sales all but disappear during coronavirus lockdowns. In April, spending on clothing was down nearly 90% from the previous year. Neiman Marcus, JCPenney, and J.Crew, which were all under pressure before the pandemic hit, have recently filed for bankruptcy.
Well, the coronavirus pandemic took a huge hit on retail sales purely because people were stuck at home. You know, they had to stay in their houses due to the spread of the virus. So really, the only areas that we saw much spending were on food.
Sales for food and beverages haven't been as deeply impacted. While spending at bars and restaurants has gone down, people have been stocking up at grocery stores.
Spending at bars and restaurants has been hit really hard. I mean, a lot of places did manage to continue to provide takeout and curbside delivery and so on. But what we did see was a big bump in March when people were stocking up. You know, they really wanted to fulfill their shelves in preparation for the shutdowns.
Spending online, however, has accelerated. Consumers increased online purchases in May from the same period last year by almost 31%.
Well, every month that the coronavirus has been going on, we've seen a greater share of retail sales at non-store retailers, like for instance Amazon.com. For many people, the only option that they have to buy certain products is to go online and to spend online.
More recently, there have been signs that retail might be recovering. The retail sector lost almost 2.3 million jobs in April, but added nearly 370,000 back in May.
And the hope is that will continue as people kind of start to get out and about and to recover and to spend more money after the shutdowns are over. Essentially, the last phase of the recovery will be people going back, into stores, into malls, into enclosed spaces and feeling comfortable.
How confident consumers feel about going out and spending money safely will help determine how quickly retail sales might improve and ripple around the economy.
Okay, guys, I hope that helped. Did this exhaustive overview of retail sales help you? Type an A if it did, if you agree that, yeah, this retail thing, tells me it's going to be a good recovery. B, maybe, I'm still cautious. No help, I'm still concerned. Or D, not sure what to think. I'll give you guys a few moments to respond on that. Without a doubt, though, there's three components to GDP. So there's consumer spending, there's business spending, and there's government spending. There's no other input. Those three are it. And of those three, consumer spending is by far the most important. It's about 66 to 68%, depending on how you measure it. So retail sales, which is a subset of that, which you saw in the video, that needs to be strong, because people, if they're not spending, it's going to slow down the entire economy. Okay? All right. On the recovery, I got an A from Nellie, got an A from Charles, got an A from Tom. B from Jimmy. Okay, that's fine to be cautious. Anova, thank you. A, Alice, A. All right, that's good, guys. Well, I've been trying to be a positive evangelist all these weeks, and I'm going to continue to do it. And if that's rubbing off on you, I sure hope so. Thank you, Martha, because I don't want you sitting there in cash. It's got to be painful for those people that are seeing this move. Tom Keene on Bloomberg said smugly on Friday of last week when these data was coming out, yeah, I'm in cash. It's like, dude, I wouldn't be saying that on the air. I just wouldn't. So we've talked about consumer spending. I'll need to talk a little bit about industrial, and then we'll get on to the next segment. But industrial production increased month over month 1.4%. That's not a lot, but it increased. I'm not even giving you a stat where it decreased by less than the last month. It increased. The key takeaway from that is that the improvement was all manufacturing based, thanks to an uptick in motor vehicles and parts. What does that mean? People are still buying cars. Why? Because there's pent-up demand, which you saw earlier, but also because what's the interest rate to buy a car? Zip. For most any purchase right now, they will do anything they can to get you in the store. Okay? June Philly Fed. Now, this is kind of a techie number, but it's an index that follows or models, if you will, the manufacturing sector. So Philly Fed provides early indications of any problems in the manufacturing part of the country and subsequently the entire U.S. economy. This number, look at the top, 27.5 versus a consensus from Briefing. These guys are smart at Briefing, okay? Their consensus was minus 25. The prior month was minus 43. Philly Fed for June up 27.5. Just a staggering number. Okay? All right. Mortgages. Now, if we're buying houses, we got to finance them. Look at this 2020 number. Look at this whipsaw from April, just blowing past 2018 and 2019. Folks, people are buying homes and they're taking out mortgages, and that means the economy is returning to normal. That is what we want to see. Now, I put this in here as sort of a non sequitur, but I thought it was a great graph. People ask me from time to time why I talk about China, why I don't have more fear that we're going to lose China's business. Well, look at these countries on the left-hand side. The ones that have exports that are dependent on other nations like Australia, Japan, Germany. Okay? The U.S. is at the bottom. Okay? We can always import less if we can make those same goods and services at home, and I guarantee you that that's the direction the current administration wants to go. They are favoring bringing people home, repatriatizing, it's called, industry back here. It can be done with currencies and it can be done with actual businesses. But look at that short blue bar for the U.S. 17% of our economy, 17% of our economy is reliant on exports. China's number's not even on here. It's like 67%, 2/3 of their economy relies on exports. If you're relying on exports, that gives the other entity, the other country, a lot of power over you. And that essentially is what this president has been doing, is saying we're no longer going to kowtow to that. All right? Okay, last question, I think, for the night. Did this week's stock market action, we had a pullback, but then we've had some really strong days as well. Did it make you feel anxious? No, it's just a bull pause. Yes, it's a new bear market. C, I don't know, I'm just scared. Or D, not sure what to think about it. Now, just because I am a bull, we have an open screen here. You can say whatever you want. Feel free to type in a comment. You don't have to just put a letter in there. If you have something you want to say, go ahead and say it, because I'm here to answer questions. That's how we've always touted this program. Okay, so while you're answering this, I'm going to scroll back up to make sure I haven't missed any questions. All right? So I'm waiting for your letters to go in there. And I'm looking for any questions. Okay. Yeah, I answered Jimmy about the online availability. No question. That's it. And okay, we got A. We got A. We got more A. Okay. Very bullish is Todd. Okay. I pay you to figure it out. Full disclosure. Ms. Moore is a client. Now, some of you watching this program are not clients. You're welcome to be here. Some of you are clients, so I have a fiduciary responsibility to you, especially the ones in Georgia, because that's a magic place on the map, guys. I don't know how they're not getting a resurgence like Texas, like Florida, like Utah, of all places. Percentage-wise, crazy, okay? But it's a good thing. So I'm seeing those numbers, guys, and I'm going to take that as a positive. Let's look at the bull and bear case. Perhaps short airlines if security. Yeah, I'm not shorting anything in this market. That's for people that are above my pay grade. We're in a secular bull market that started around 2013 with that huge 33% return in 2013. I believe we are going to see this trend for 15 to 18 years. And it's on recording right now, me saying that, okay? All right, so each week we look at both sides for owning a stock. Now, I've shown you how this works twice. This will be the last time because some of you have seen it before. Basically, how the signaling works. So if you were a market maker on the floor before everything was computerized, if you wanted to buy something, you motion with your hands. Hey, bring it to me. Bring it to me. I want to buy it. Motion toward yourself, okay? If you don't like it, it's like, oh, get this thing away from me. Get this ugly stock away from me, okay? And that's why I'm making those faces, because most of the time in the pits, those guys are pretty emotional because they're trading lots and lots of money, and it's real life for them, okay? And then there are times when we don't really know what we're going to trade, all right? And so I've got these puzzled looks on my face here, and I try to never be that way. If I am on your, with anything in your portfolio, you'd be knowing about it, I'm sure. Okay, so now I want to say here, I always talk my book. So if I'm bullish on something, it's in your portfolios. If you're trading that program, okay? So I have 4 programs, CG, DG, all right, SG, and GI. So if you've got a stock that's in there and I'm bullish on it, we own it. If I'm selling it, or if it's a bear case, then I don't own it, all right? So here's the bull case. These are various opinions that I've aggregated, and you're going to come to an opinion here. So Coke has been a stalwart dividend payer, even with stagnant growth, okay? Quantitative easing's effect on interest rates still represents one last hurrah, hence my bullish rating. Now, that's not me saying that. That's this analyst that I'm reading here, okay? On the bright note, the dividend payer has been consistent, raised dividends every year for 58 years. The trend is set to continue. That's what the bulls believe that I read. The bear case, Coke's glory days are gone. Their days of exponential operating cash flow ended 7 years ago. The stock has appreciated mostly on the strength of that dividend payout that I just mentioned. And now the dividend payout is starting to equal operating cash, meaning 1-to-1. So we can't expect the same dividend growth as before. Those are very different opinions. So in the engine there, I'll wait for you guys. Type bull or bear. Which case wins it, bull or bear? Or you can type a B for buy and an S for sell. Please do not type BS because I'll get censored. Okay, we're operating on about a 25-second delay, so I'm going to wait to see some votes here, and then I will move forward. All right. Any votes? I'm bullish for sure on the steam engine's fangs. Okay, that's good, Jimmy. Yeah, we're along the fangs ourselves. So, okay, any votes? BEA, sell. Okay. Bear. Nellie Moore, you're a bear? You're in Atlanta. That's the home of Coca-Cola. Hold, not healthy, bearish. Okay. The answer is sell. Why? Because the single focus beverage is riskier than Pepsi. We've had both of these stocks over the years, almost always have one of the two of them in our portfolios, but the diversification of the product line from Pepsi we like a lot more, and that's what we're holding. All right? Thanks, guys. Looks like most of you agree with me. Maybe not all of you, but that's okay. A market needs both bulls and bears. If everybody's bullish or everybody's bearish, nobody trades because there's nobody to take the other side of the trade. All right? So Shopify. Okay, so this company allows people to basically put their own website up and sell independently. But the news this week was that Shopify wants to really go after Amazon and their dominance. So they announced a new partnership with retail giant Walmart. The agreement creates an alliance that will make both companies a more formidable foe against Amazon. Well, that's a pretty big deal, okay? Shop will automatically sync its merchants' products on Walmart. So Amazon's been doing this for a long time where they have third-party people. It looks like it's all Amazon, but there are really a bunch of third-party people on there. And that's why when you go to check out, you see, well, this is shipping from here, this is shipping from here, this is shipping from here. Do you follow me? So Shop launched its Shopify Fulfillment Network, which increased its market footprint. So those are pretty good. However, on the bear side, Facebook is rolling out their shop feature because Facebook, Zuckerberg, and those folks think that the future of e-commerce is actually within social media and not with independent platforms. Okay, therefore, Shopify is set to suffer the most because they are an independent e-commerce platform. Shopify is trapped between these two giants, Amazon and the other huge entity, Facebook, and anyone else that chooses. Google could choose to enter this too. So is this a bear or is this a bull? I'm looking in the line here. We got a buy from Tom, okay? Those of you that are clients can cheat because you can look in your portfolios and see if it's in there or not, okay? I think, again, we got about a 20-second delay, so I'm just going to hold on for a little bit. And give you guys a chance to vote. We got anybody else wanting to vote? Bull or bear case for Shopify? All right, not seeing any. I'm going to move forward. It is a bull. It is not wise to bet against Walmart. Now, I realize the stock in play here is Shopify, but when you're partnering with Walmart, which is the only bona fide competitor for Amazon, you are coattailing against the behemoth, and you are using Walmart to do that. Do not bet against Walmart. And you can see on the screen here, we bought Shopify at $5.15. Today it traded at $8.67. I wish all our trades went this way. Full disclosure, they do not. But Shopify is absolutely a buy. Okay, the third and final one tonight, Citrix Systems. Citrix may hold a decent long-term value against rosy earnings growth. Okay, so these are fundamental GARP and PEG, fundamental components, which I won't get into, but they have high operating margins versus the typical S&P 500 business because they're an electronic entity. Robust upside momentum and buying trends are standout bullish signals. Continuing here, they have definitely been a winner during the shutdown here. Okay, so if that's the case, what's the bear case? Okay, all right. Disappointing guidance and a 52-week high do not add up. Well, the 52-week high was just 2 days ago. All right, full year 20 guidance is actually calling for 3 to 4% growth, which is smaller than the people were expected when the earnings were announced, and the stock popping up 7% since that earnings report. Well, the valuation is like 24 times forward earnings. Still, it's a very powerful stock. Citrix, this may be the toughest one for you guys, all right? We have a bull or we have a bear on the Citrix Systems. Anybody? Oh, Andre, we got a buy. Tempted to cheat, but that's no fun. That's good, Nelly. All right. We got buys. Anybody else? I'm going to click it. This may be a surprise, guys. It's a sell, and here's why it's a sell. I sold it 2 days ago as it hit that lifetime high. I believe it is an overvaluation, runaway price situation on this stock. because their recent earnings forecast tells me that there's too much risk in it for our clients. Now, you can still be bullish on this stock. Our client base mostly are retirees. We are not speculative traders. So for us, we took the money and we ran. All right. You may come to a different conclusion, but that's what worked for us. All right. Okay. So that's it. I want you to, I think we're going to get out of here a little earlier tonight. Know that when we post our videos from now on, we have them indexed. So if you want to go back and watch any of the sections, we're like the data section up front with all that COVID-19 stuff, or you want to refer it to a friend, you can go to the slot or just click on the number, and I think it forwards in the video there. It's really convenient. Okay. So we'd like you to pass that along to people. You can reach us here at our email. That's our office phone number, website, Twitter, Facebook. Pretty much any way you want to reach us, you can. We are trying to get to 1,000 subscribers by New Year's Eve. 1,000 subscribers. I think we just crossed 50. We got a ways to go, guys. And it would really help if you could do that. We get some benefits from YouTube, a little bit faster placement, reissuing of the videos, etc. But, just appreciate so much you guys being here. And so in summary for tonight, I want to always end with this. For we have not been given a spirit of fear, but a spirit of power, a spirit of love, and of a sound mind. I love that phrase. 1 Timothy. And it is my deeply held belief, and I say this in so sincerity, folks, that we will not only survive this pandemic, but we will flourish in a way that we never have before. I want you to know that I appreciate each and every one of you. I appreciate you watching, telling your friends, and we'll be here next week. That's our show for Thursday, June 18th. I'm Charles Brown, Portfolio Manager with CB3 Financial Group. From COVID to clarity, this is CB3 Live.